Two forces have always shaped the movement of money: power and pressure. Power decides who controls the system. Pressure decides when the system changes. Before we get into it, don't forget to drop a like and subscribe. Right now, both are converging around Bitcoin in a way very few people fully understand. Because beneath the surface of price charts and headlines, something much bigger is happening. Central banks are quietly preparing for a new monetary era. Institutions are slowly repositioning capital, and the same forces that have funded wars and shaped global economies for more than a century are now colliding with a fixed, neutral monetary asset for the first time in modern history. This isn't just another Bitcoin cycle, it's a structural shift, and if you understand the incentives behind it, you'll start to see why the next surge in Bitcoin may not look like anything we've seen before. Before we get into institutions and capital flows, we need to start with something more fundamental, because most people still don't understand how the current system actually works. The modern monetary system isn't built on savings, it's built on credit. When most people think about banks, they imagine financial intermediaries, institutions that take deposits from savers and lend that money to borrowers. But that isn't how the system operates at scale. In reality, banks create money. When a loan is issued, the money doesn't come from a vault somewhere or from someone else's savings. It's created at the moment the loan is approved. New purchasing power appears in the borrower's account, expanding the total money supply. That means the vast majority of money in circulation today exists because someone, somewhere, went into debt. This is the core mechanism of the modern economy. Money is created through lending, and growth depends on the continuous expansion of credit. As long as new loans are issued, the system grows, asset prices rise, liquidity flows, confidence remains intact. But when credit expansion slows, everything begins to tighten. Markets contract, liquidity dries up, and the system becomes fragile.
This dynamic has shaped nearly every major financial cycle of the past century. Housing booms, stock market rallies, and economic expansions are all heavily influenced by where credit flows and how quickly it expands. When banks increase lending into real estate, housing prices rise. When credit flows into financial assets, markets surge. It creates the appearance of organic growth, but underneath, much of that growth is credit-driven. And this is where the system reveals its deeper implications. Because when money is created through debt, expansion becomes a necessity. The system requires constant growth in credit just to remain stable. Without it, the structure begins to seize. That dependence on expansion doesn't just influence markets, it influences governments, and historically, it has influenced war. The connection between central banking and war is rarely discussed openly, but it's deeply embedded in the origins of modern finance. Central banks were not originally created simply to stabilize economies or smooth business cycles. They were created to finance large-scale government spending, particularly during times of conflict. Before centralized monetary systems existed, wars were limited by available resources. Governments had to raise taxes or borrow directly from citizens to fund military campaigns. When funds ran out, wars ended. But with the emergence of central banking and fiat currency, those constraints changed. Governments could now issue bonds. Central banks could purchase those bonds, and new money could be created to finance spending. For the first time in history, large-scale conflict could be funded without immediate taxation. The costs were deferred, often hidden through inflation and long-term debt expansion. This shift allowed wars to become longer, more complex, and more financially sustainable for the states involved. Over time, the relationship between monetary expansion and government spending became deeply intertwined. Central banks provided liquidity during crises, governments relied on that liquidity to fund deficits, and the cycle of expansion continued. This system has persisted for decades because it works, at least in the short term. It allows economies to grow, markets to function, and governments to operate without constant resource constraints. But it also creates long-term imbalances. debt accumulates, currency supply expands, and asset prices become increasingly dependent on monetary intervention. For most of modern history, there hasn't been a viable alternative, until now. Bitcoin introduced something fundamentally different, a monetary asset with no central issuer.
No adjustable supply, and no dependency on credit expansion. There will only ever be 21 million Bitcoin. That fixed supply changes the dynamics of money in a profound way. It removes the ability to expand the monetary base at will. It eliminates the link between money creation and debt issuance, and it introduces a form of scarcity that operates independently of political or institutional control. At first, this was viewed as an experiment, then as a speculative asset, then as a hedge, but increasingly, it's being understood as something much larger, a parallel monetary system that exists outside traditional credit structures. The question now isn't whether Bitcoin works technologically, it's whether the incentives of global capital are shifting toward it. And this is where institutional behavior becomes critical. Markets don't move simply because something is innovative or intellectually compelling. They move when incentives change. Large pools of capital, pension funds, sovereign wealth funds, insurance companies, and endowments don't allocate based on ideology. They allocate based on risk, return, and necessity. For years, institutions had little incentive to seriously consider Bitcoin. Traditional assets were performing well. Equity markets delivered strong returns. Bonds provided stability. Real estate offered income and appreciation. There was no urgent need to explore alternatives. At the same time, the career risk associated with Bitcoin remained high. Allocating to an emerging digital asset carried reputational and professional consequences if it underperformed. For many institutional managers, the safest decision was simply to avoid it. This dynamic can be summarized by two powerful forces: fear and need. As long as traditional portfolios delivered acceptable returns, the need for Bitcoin remained low, and as long as career risk remained high, fear acted as a barrier to entry. The result was slow, cautious adoption, despite growing awareness. But incentives don't remain static forever. They shift as conditions change. One of the most significant shifts now emerging comes from technological disruption, particularly in artificial intelligence. For more than a decade, major growth companies dominated global markets. Their business models appeared durable, their margins were strong, and their competitive advantages seemed secure. AI is beginning to challenge that stability.
As artificial intelligence accelerates, the barriers to building new products and services are falling rapidly. Code is becoming more accessible. Innovation cycles are shortening, and competitive advantages that once took years to establish can now be challenged in months. This environment introduces uncertainty into sectors that were previously considered predictable. When predictability declines, so does institutional comfort, and when comfort declines, the search for alternative stores of value begins. Bitcoin occupies a unique position in this evolving landscape. Unlike traditional companies, it doesn't rely on revenue growth or market share. It doesn't face margin compression or competitive disruption in the conventional sense. Its value proposition is rooted in scarcity, neutrality, and network adoption, rather than operational performance. In a world where many assets must continuously defend their valuations through innovation and growth, an asset that simply exists with fixed supply begins to look structurally different, not because it promises exponential cash flows, but because it operates outside the competitive dynamics affecting most other investments. This distinction becomes increasingly relevant as global capital evaluates long-term allocation strategies. If traditional growth assets face more volatility and uncertainty, and if monetary expansion continues to shape currency values, the appeal of a neutral, scarce asset grows. Demographics also play a role. Over the coming decades, significant wealth will transfer from older generations to younger ones. Younger investors tend to be more comfortable with digital assets and less anchored to traditional financial paradigms. As that transfer occurs, allocation preferences may shift accordingly. This doesn't happen overnight. Capital moves slowly. Incentives change gradually. But history shows that when they do change, they often change all at once. For now, the market sits in a transitional phase. Early adopters who accumulated Bitcoin years ago are more financially secure and may reduce their holdings. New institutional participants are gaining access through regulated vehicles and custodial infrastructure. Governments and central banks are studying digital assets more closely, even as they develop their own digital currencies. Beneath the surface, a quiet reallocation is underway, not driven by hype, but by necessity. Bitcoin doesn't require universal belief to succeed. It only requires that a portion of global capital eventually views it as essential rather than optional. And that shift is driven less by narrative than by pressure. Pressure from inflation, pressure from technological disruption, pressure from geopolitical uncertainty, and the evolving role of central banks in financing government activity.
When those pressures converge, the movement of capital can accelerate rapidly. What appears gradual for years can suddenly become obvious. Allocations that once seemed risky begin to look prudent. Assets once considered speculative begin to look strategic. This is why focusing solely on short-term price action can be misleading. Sideways markets and periods of low enthusiasm often occur during phases of structural transition. Early believers adjust positions, new participants prepare, and incentives slowly realign. The deeper story isn't about daily volatility, it's about long-term positioning. Central banks will continue to manage currencies and support government financing. Institutions will continue to seek stable returns and manage risk, and global markets will continue to evolve in response to technological and geopolitical change. Within that environment, Bitcoin represents something fundamentally new, a monetary asset independent of credit expansion, independent of national policy, and increasingly integrated into global financial infrastructure. Its role in the coming years won't be defined solely by speculation or ideology. It will be defined by how effectively it addresses the needs and constraints of the world's largest capital pools. When those pools begin to view it as a necessary component of long-term strategy rather than a peripheral experiment, the scale of potential allocation becomes significant. That doesn't mean the transition will be smooth or immediate. Adoption rarely is. It unfolds through phases of skepticism, experimentation, and gradual acceptance, but the direction of incentives matters more than the pace. Power still shapes the system, but pressure shapes its evolution. And as central banks, geopolitical realities, and institutional strategies continue to intersect with a fixed, decentralized monetary network, the conditions for Bitcoin's next major surge may already be forming quietly beneath the surface. Not driven by hype, not driven by headlines, but driven by the slow, powerful shift of incentives that ultimately moves global capital. The question isn't whether that shift is happening, it's how quickly it accelerates from here. Thanks for watching. Hope to see you in the next video. Don't forget to like and subscribe.